Welcome to Stock Shots. We're so pleased to have as our guest tonight Mr. Peter Schiff, president of Euro Pacific Capital and author of the bestseller Crash Proof. Crash Proof is a must-read for the individual investor. The entire interview is approximately 30 minutes long. For the entire interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.
We're here tonight with Mr. Peter Schiff, author of Crash Proof. Mr. Schiff, thanks for visiting with us on Stock Shots tonight.
Sure, thanks for having me as a guest.
Mr. Schiff, you argued in a recent interview on Fox News that the dollar just can't go up. Would you please elaborate on your thoughts there, because so many of the pundits right now are saying that the dollar has bottomed?
Well, that's wishful thinking, and many of these same pundits have been saying the dollar's been bottoming for years. And, of course, it keeps hitting a new low. And this recent rally that we've had is going to be temporary. In fact, the dollar just hit a new record low against the Australian dollar on Friday. So the dollar bounced against some currencies, but against other currencies it's still going down. But the reason I said that we really can't have a meaningful rally in the dollar is that the Fed really doesn't have the ability to support the dollar the way it did, let's say in 1980, when in order to arrest the dollar's decline, Paul Volcker had to move interest rates up to 20%. See, the problem is, in order to raise interest rates sufficiently to make the dollar attractive on a real return basis, rates would have to be so high that our entire economy would collapse, because we're now so leveraged. We've borrowed so much money. We owe the world trillions, and we have short-term debt, not only individuals with their adjustable rate mortgages, but the national debt is financed with Treasury bills, not long-term bonds like it used to be. So if the Fed raised interest rates to defend the dollar, the economy would collapse, and the dollar would fall even faster because people would be fleeing U.S. assets. So there's really no way to stop the dollar from falling. All the Fed can do is try to make sure that the fall isn't, total, that the dollar doesn't lose all of its value. It just loses a lot of value. But even to do that, even to make sure the dollar maintains some of its value, is going to require a substantial interest rate increases and a very, very severe recession.
So your contention is that as interest rates go up, the dollar could go up, but there's no way that we can get interest rates to the point to sufficiently help the dollar.
I think if interest rates go up, the dollar will still go down. It's just if we raise interest rates high enough, the dollar might only go down by 40 or 50%, which is still a lot. But if we don't raise them at all, then the dollar could go down 80 or 90% or more.
Well, is a good hedge the euro? Because in my thinking, it looks like the eurozone will typically follow the U.S. economy. So is the euro a bad bet against the dollar right now?
No, I think it's a good bet. It's not the only bet. I think people should have money all around the world. I think the currencies with the most potential lie in Asia. But, those countries are also acting to weaken their currencies to keep the dollar supported. So in the short run, and over the years, we've gotten better protection against the weak dollar from European currencies, from Scandinavian currencies, from Australia, New Zealand, from Canada. But ultimately, I think you're going to see bigger moves out of these Asian countries once they really let the dollar collapse. But there's no way to know exactly how long it's going to be before they come to their senses.
How do you suggest that the small investor best play the weak dollar? Do you like
by getting out of it? The people, large or small, there's no reason to hold U.S. dollar assets, whether you're talking about a savings account or whether you have a brokerage account and you're buying stocks and bonds. The dollar is going to be undermined. Look, there was an article, I think it was in the USA Today, that showed that the average American family share of the national debt, funded and unfunded liabilities, is well in excess of $500,000. Obviously, the average American family doesn't have $500,000 to pay off this debt. So the only way it can be paid, in quotes, is to be repudiated through inflation. So the government's going to have to create a massive amount of inflation to inflate away these liabilities. And so, obviously, when that happens, the value of the dollar plunges. So if you've got dollars and you know its future value is going to decline, then it makes no sense whatsoever to hold on to them. And so people need to look abroad. They need to look at other currencies that don't have these problems and save and invest in those countries and in those currencies. And also, it's obvious to me that the American standard of living is going to substantially decline relative to the living standards in the rest of the world. And so if you want to own assets, it makes sense to own assets in countries where the assets are going to gain value, not in America where assets are going to lose value.
What's your favorite country right now? Do you have a favorite?
Well, I mean, I don't know. I mean, I like investing in Singapore and Hong Kong, and I've liked Australia, New Zealand. As I said, Switzerland has always been a spot that I've liked to put money. And recently, as I said, we have been adding money into Japan and Scandinavia. I mean, I don't have everything in one basket. I mean, there's interesting companies in all countries in different asset classes, and the key for me is to get a good dividend yield, have some appreciation potential, and to be in currencies which I think will maintain their value better than the dollar. I think all currencies are likely to lose value based on the amount of money that's being printed. So, we also own gold as a store of value and as a hedge against all currencies declining. But of the currencies that are in the most jeopardy, of the major currencies, it'd be the U.S. dollar. And just because people live here and work here doesn't mean that there isn't a tremendous risk to your standard of living from a weak dollar, and that you shouldn't take actions to protect yourself.
Well, we're now hearing a lot of people talk about oil turning around and going right back down to $70.
Well, these are the same people. I mean, guys like Steve Forbes, has ever since oil hit $40 or $50 a barrel, the majority of so this is a bubble. Oil's going to collapse. When it was at $70, I mean, Steve Forbes was saying it's going back down to 35. They said it's the biggest bubble. Here we are, $127 a barrel. And, of course, it's the same people that are saying it's going to go down. They don't understand the fundamentals. This is not a bubble. Oil is not a bubble. And I've got a very good track record of calling bubbles, because I called the NASDAQ bubble before it burst. I called the housing bubble before it burst. But this is not a bubble in commodities. These are real price increases brought about by inflation. The inflation created by the central banks around the world, first the Fed and then every place else. It's that inflation that initially showed up as bubbles, but is now showing up as higher prices. A lot of times when inflation gets introduced into the monetary system through the banks and the investment firms, that before it shows up in higher consumer prices, it first shows up in higher asset prices. And that's exactly what happened. But the final resting place for inflation is always in consumer goods, and that's what we're seeing right now. And these are real price increases. These are not speculators driving the price of oil. This is the natural reaction to the weakening of currencies. Prices have to rise to create an equilibrium. And it's not just oil. Commodity prices across the board are going up. Oil's not rising in a vacuum.
So you would completely disagree with all the so-called experts that are now arguing a bet against the American consumer is a losing bet?
No, I mean, that's the only bet that's winning right now. Anybody who's betting on the American consumer is getting crushed. If you look at all the U.S. companies, the ones that are doing the worst are the ones that are domestically focused. The only U.S. companies that are doing well are those who are deriving their revenues from abroad. And every time you hear one of these companies report earnings, they always come out and say, well, the domestic earnings were lousy, but we made up for it with stellar earnings from abroad. And even if you look at certain companies, like Jack in the Box came out last week with terrible earnings because all their restaurants are in America. But McDonald's or Yum Brands come out with good earnings because they have a lot of restaurants abroad. So it's the American consumer is done. Put a fork in him. He's completely finished.
For the rest of this great interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.